Learning outcomes. After studying this module, you shall be able to know the process of book building methods of issuing shares, learn the process of book building, understand the difference between fixed price and book building methods, and evaluate the book building method. Introduction. An initial public offer, that is IPO, is the selling of securities to the public in the primary market. This initial public offering can be made through fixed price method, book building method, or a combination of both. Now, what is book building? Book building is basically a capital issuance process used in IPO and follow-on public offers which aids price and demand discovery. It is a process used for marketing a public offer of equity share of a company. It is a mechanism where during the period for which the book for the IPO is open, bids are collected from the investors at various prices which are above or equal to the floor price. The process aims at tapping both wholesale and retail investors. The issue or offer price is then determined after the bid closing date based on certain evaluation criteria. The process is directed towards both the institutional as well as the retail investors. The issue price is determined after the bid closure based on the demand generated in the process. In case the issuer chooses to issue securities through the book building route, then as per SEBI guidelines, an issuer company can issue securities in the following manner: 100% of the net offer to the public through book building route, 75% of the net offer to the public through the book building process, and 25% through the fixed price portion. Under the 90% scheme, this percentage would be 90% and 10% respectively. The characteristics of book building. Price band. The range of price, that is the highest and the lowest price at which the offer for the subscription of securities is made, is known as price band. Investors may bid any price within the price band. Floor price. Floor price is the minimum price set by the lead manager in consultation with the issuer. This is the price at which the issue is open for subscription. Investors are free to place a bid at any price higher than the floor price. The tendering process. Book building involves inviting subscription to a public offer of securities, essentially through a tendering process. Eligible investors are required to place their bids for the number of shares to be issued and the price at which they are willing to invest, with the lead manager running the book. At the end of the cutoff period, the lead manager determines the response to the issue in terms of the quantum of shares and the highest price at which demand is sufficient to match the size of the issue. Bid. The investor can place a bid with the authorized lead manager. In the case of equity shares, usually several brokers in the stock exchanges are also authorized by the lead manager. The investor fills up a bid cum application form which gives a choice to bid for up to 3 optional prices. The price and demand options submitted by the bidder are treated as optional demands and are not cumulated. Allotment. The lead manager in consultation with the issuer decides the price at which the issue will be subscribed and proceeds to allot shares to investors who have bid at or above the fixed price. All investors are allotted shares at the same fixed price. For an allottee, therefore, the price would be equal to or less than the price bid. Participants. There are 3 kinds of investors in a book building process. The very first, retail individual investors. It is an investor who applies for securities for a value of not more than 2 lakh rupees. Non-institutional investors. Any bid exceeding rupees 2 lakh amount is considered in the non-institutional investors category. NIIs are commonly referred to as high net worth individuals. The third, qualified institutional buyers. They are institutional investors who possess the expertise and funds to invest in the securities market. Mutual funds, financial institutions, scheduled commercial banks, insurance companies, provident fund, state industrial development corporations, they all come in this category. Generally, all investors, including individuals eligible to invest in a particular issue of security, can participate in the book building process. However, if the issue is restricted to qualified institutional investors, as in the case of government securities, then only those eligible can participate. The principal parties or intermediaries involved in a book building process are: number 1, the issuer or the company; number 2, the book running lead manager, who is a merchant banker registered with SEBI; third, the syndicate members who are intermediaries registered with SEBI and who are permitted to carry on activities as underwriters. Syndicate members are appointed by the book running lead managers. Now we proceed to the process of book building. The issuer who is planning an offer nominates lead merchant banker as book runners. A draft offer document is sent to the SEBI. Circulation of information memorandum. Filing of red herring prospectus at least 3 days before the opening of the offer. The issuer specifies the number of securities to be issued and the price band for the bids. The issuer also appoints syndicate members with whom orders are to be placed by the investors. The syndicate members input the orders into an electronic book. This process is called bidding and is similar to open auction. The book normally remains open for a period of 5 days. Bids have to be entered within the specified price band. Bids can be revised by the bidders before the book closes. On the close of the book building process, the book runner evaluates the bid on the basis of the demand at various price levels. The book runner and the issuer decides the final price at which the securities shall be issued. Generally, the number of shares are fixed. The issue size gets frozen based on the final price per share. The final prospectus specifying the price and size of the offer is then issued. Allocation of security is made to the successful bidders and the rest gets refund orders. Every public offer through the book building process has a book running lead manager, which is a merchant banker who manages the issue. The investor has to bid for a quantity of share he wished to subscribe to within this band. The upper price of the band can be a maximum of 1.2 times the floor price. Further, an order book in which the investor can state the quantity of the stock they are willing to buy at the price within the band is built. Thus, the term book building. An issue through book building route remains open for a period of 3 to 7 days and can be extended by another 3 days if the issuer decides to revise the floor price and the band. Now we have to look at the difference between the fixed price and the book building issue process. Fixed price process: price at which the securities are offered or allotted is known in advance to the investor, whereas in case of the book building process, price at which securities will be offered or allotted is not known in advance to the investors. Only an indicative price range is known. In fixed price method, demand for the securities offered is known only after the closure of the issue, whereas in book building, demand for the securities offered can be known every day as the book is built. The third difference, payment is made at the time of subscription wherein refund is given after allocation in case of the fixed price method, whereas in book building, payment is made only after allocation. Types of investors in book building. There are three kinds of investors in our book building issue. First, the retail individual investors. It is an investor who applies for stocks for a value of not more than rupees 1 lakh. Second, non-institutional investors. Any bid exceeding rupees 1 lakh in amount is considered in this category. They are commonly referred to as high net worth individuals. Third, qualified institutional buyers. They are the institutional investors who possess the expertise and the financial muscle to invest in the securities market. For example, the mutual funds, financial institutions, scheduled commercial banks, insurance companies, provident funds, state industrial development corporations, etc. The principal parties or intermediaries involved in a book building process are the issuer company, the book running lead manager who is a merchant banker registered with SEBI, the syndicate members who are intermediaries registered with SEBI and who are permitted to carry on activities as underwriters. Syndicate members are appointed by the book running lead manager. Now we move to the limitations of book building. While many big issues of the companies in India are coming through book building is appropriate for mega issues only. The issuer company should be fundamentally strong and well known to the investors. It works efficiently in matured market conditions as there is a possibility of price rigging on listing as promoters may try to bail out syndicate members. Book building is appropriate for mega issues only where the companies can adjust the attributes of the offer according to the preferences of the potential investors. It may not be possible in all kinds of public issue. Secondly, book building system is suitable only for the issuer companies which are fundamentally strong and well known to the investors. Third, the book building system works very efficiently in matured market conditions. Fourth, the system works where the investors are aware of the various parameters affecting the market price of the securities. Retail investors find it difficult to participate in the issue on account of lack of expertise. Fifth, there is a possibility of price rigging on listing as promoters may try to bail out the syndicate members. Now we move to a topic, information memorandum. A public company making an issue of security may circulate information memorandum to the public prior to filing of a prospectus. A company inviting subscription by an information memorandum shall be bound to file a prospectus prior to the opening of the subscription list and the offer as a red herring prospectus at least 3 days before the opening of the offer. Red herring prospectus means a prospectus which does not have complete particulars on the price of the securities offered and the quantum of securities offered. The information memorandum and red herring prospectus shall carry same obligations as are applicable in case of a prospectus. Any variation between the information memorandum and the red herring prospectus shall be highlighted as variations by the issuing company and shall be individually intimated to the persons invited to subscribe to the issue of securities. In the event of the issuing company or the underwriters to the issue have invited or received advance subscription by way of cash or post-dated checks or stock invest, the company or such underwriters or bankers to the issue shall not encash such subscription money or post-dated checks or stock invest before the date of opening of the issue without having individually intimated the prospective subscribers of the variations and without having offered an opportunity to such prospective subscribers to withdraw their application and cancel their post-dated checks or stock invest or return of the subscription paid. Any application for subscription which is acted upon by the company or underwriters or bankers to the issue without having given enough information of any variation or the particulars of withdrawing the offer or opportunity for cancelling the post-dated checks or stock invest or stop payments for such payment shall be void and the applicants shall be entitled to receive a refund or return of its post-dated checks or stock invest or subscription money or cancellation of its application. Upon the closing of the offer of securities, a final prospectus stating therein the total capital raised, whether by way of debt or share capital, and the closing price of the securities and any other details as were not complete in the red herring prospectus shall be filed in a case of a listed public company with SEBI and registrar, and in any other case with the registrar only. What is a red herring prospectus? A red herring prospectus is a prospectus which does not have details of either price or number of shares being offered or the amount of issue. The issuer, that is the company, along with the book running lead manager, sets a base price and a price band within which the investors are allowed to bid for the shares. On the completion of the bidding process, the details of the final price are disclosed through a prospectus. The red herring prospectus is to be filed with the registrar of companies by unlisted public company and with SEBI by the listed public company at least 3 days prior to the opening of the offer. The final prospectus shall be similarly filed with registrar of companies or SEBI on closure of the offer of securities, indicating therein the total capital raised, closing price and other details as were not complete in the red herring prospectus. Where a company possessed to issue capital to the public through big building process, the relevant red herring prospectus shall contain the disclosures specified in section 26 of the Companies Act 2013. What is a green shoe option? A company making an initial public offer of equity shares through the book building mechanism can avail of the green shoe option for stabilizing the post listing price of its shares. The green shoe option means an option of allotting shares in excess of the shares included in the public issue and operating a post listing price stabilization mechanism through a stabilizing agent. Green shoe option is a system of IPO using book building method was recognized by SEBI in India through its new guidelines issued in 2003. According to the SEBI guidelines, a company desirous of availing the green shoe option shall in the resolution of the general meeting authorizing the public issue seek authorization also for the possibility of allotment of further shares to the management team as the SA. who will be responsible for price stabilization process if required. It owes its origin to the Greenshoe Company, which used this option for the first time in the world. Let us summarize. Book building is essentially a process used by companies raising capital through public offering to aid price and demand discovery. In this method, the issuer sets a base price and a band within which the investor is allowed to bid for the shares. Red herring prospectus means a prospectus which does not include complete particulars of the quantum or price of the securities included therein.